The bearish engulfing pattern is a significant indicator in the realm of trading, signaling a potential reversal from an uptrend to a downtrend. This pattern emerges when a smaller bullish candle is followed by a larger bearish candle, completely engulfing the body of the previous candle. This visual contrast suggests that selling pressure has overtaken buying momentum, hinting at a shift in market sentiment. Traders often view the bearish engulfing pattern as a cue to consider opening short positions or closing existing long positions, given its potential to precede a downward movement in price. However, it is crucial to note that no single pattern guarantees market movements with absolute certainty. Therefore, integrating this pattern into a comprehensive analysis, including other technical indicators and market context, is advisable to strengthen decision-making. To hone the skill of identifying and interpreting the bearish engulfing pattern, continuous practice is essential. Engaging with real-time market charts and historical data can provide valuable experience, sharpening the ability to spot this pattern and similar technical signals amidst the vast array of market data. In conclusion, the dynamic nature of trading demands a commitment to continuous learning and adaptability. The bearish engulfing pattern, while a powerful tool in technical analysis, serves as a single piece in the vast puzzle of market analysis. Traders should strive to broaden their knowledge base, stay updated on market trends, and regularly refine their strategies to navigate the complexities of the trading world effectively. Candlestick patterns play a crucial role in technical analysis by providing visual insights into market sentiment and potential price movements. These patterns are formed by the price movements of an asset within a specific time frame, reflecting the open, high, low, and close prices during that period. Traders utilize these patterns to make informed decisions about future market movements. Among the various candlestick patterns, tweezer tops stand out as a significant indicator of a potential bearish reversal, especially when they appear at market highs. This pattern is characterized by two or more consecutive candlesticks with matching high points, signifying resistance at a particular price level. The first candlestick in a tweezer top pattern typically indicates the continuation of an uptrend with a significant high point. In contrast, the following candlestick or candlesticks show a stall or decrease in price, suggesting that buyers are losing control and a reversal to a downtrend may be imminent. By recognizing the formation of tweezer tops, traders can gauge the strength of an ongoing uptrend and anticipate a possible shift in market direction towards a decline. This insight allows for strategic decision-making in terms of entry and exit points in the market, highlighting the value of candlestick patterns in predicting potential price movements. The tweezer tops candlestick pattern is a tool used in technical analysis to identify potential bearish reversals in the market. This pattern occurs when two or more consecutive candlesticks have almost the same high point or top, following a strong upward trend in price. Typically, the first candlestick in the tweezer tops pattern is bullish, indicating the continuation of the upward trend. However, the appearance of a subsequent candlestick or candlesticks with a similar high point suggests that buying pressure is starting to wane, and a potential reversal to a downward trend could be imminent. Visually, imagine viewing a chart where, after a noticeable ascent in prices, you see two sticks standing side by side, reaching nearly the same height. The first stick, representing the initial candlestick, stretches upwards, its top glowing green, signifying buyers pushing the price higher. Right beside it, The second stick reaches upwards almost to the same point, but is colored red, indicating sellers starting to take control and nullify the prior gains. This visual representation through candlesticks signals to investors that the current uptrend may be losing steam, and caution is advised as a shift to a bearish trend could be on the horizon. In different market scenarios, the Tweezer Tops pattern may slightly vary in appearance, but the essence remains consistent. A battle between buyers and sellers where the sellers are beginning to win, signaling a potential shift in market direction. Whether in the stock market, commodities, or foreign exchange markets, recognizing this pattern can be crucial in making informed trading decisions. By identifying this point of resistance and potential trend reversal, investors can adjust their strategies accordingly to manage risk and seek opportunities elsewhere. Tweezer tops refer to a bearish reversal pattern observed in financial markets, signifying a potential shift from an uptrend to a downtrend. This pattern is characterized by two candlesticks that have nearly the same high price point, indicating a level of resistance that the market struggles to surpass. The specific features that identify tweezer tops include the shape, size, and color of the candles, as well as their positioning at market highs. The first candlestick in a tweezer tops pattern is typically green or white, signifying an upward price movement. The second candlestick is red or black, indicating a reversal with prices closing lower. Both candlesticks have small bodies, suggestive of a market indecision, with long upper shadows that demonstrate the price pushed to a high before retracting. It is vital that these candles appear after a price increase, establishing their significance at market highs where potential reversals are closely monitored. The importance of their positioning cannot be overstated. Appearing after an uptrend, the tweezer tops pattern signals that buying pressure is waning and a bear market may be forthcoming. Despite attempts to push the market further, the failure to exceed the high set by the first candle suggests a lack of bullish momentum, leading investors to consider protective measures or prepare for a downward trend. To illustrate real instances of tweezer tops in various market conditions, let's consider a hypothetical chart scenario where an asset has been in an upward trend for several weeks. As the price reaches new highs, two candlesticks form with tops at the exact same level, right at the peak of the trend. The first candle is green, reflecting the continuation of the uptrend, and the second is red, signaling a potential reversal. This pattern would alert traders to proceed with caution, considering the possibility of the trend reversing. Understanding tweezer tops is crucial for traders looking to harness technical analysis for better decision making. By recognizing these patterns and their implications, investors can navigate market conditions more strategically, taking preventive actions to mitigate losses when bearish trends are anticipated. The tweezer tops pattern in technical analysis is a clear indicator of a shift in market sentiment from bullish to bearish. It signifies a moment in the market when the buyers, who had previously been driving the price upwards, start losing their strength, and the sellers begin to take over. This pattern is characterized by two consecutive candlesticks that have almost identical highs, with the second failing to close above the first. This visual representation serves as an alert to traders that the buyers are no longer able to push the price higher, suggesting a potential reversal in the market's direction. When this pattern appears at the peak of an upward trend, it reflects a critical point where the momentum starts to wane. The psychology behind this pattern is rooted in the balance of power between buyers and sellers. Initially, buyers are in control, maintaining the price's upward movement. However, as soon as the sellers match the buyer's strength and prevent the price from closing higher, a psychological shift occurs. Traders begin to recognize that the bullish momentum may be exhausted, leading to increased selling activity. This can result in a downturn in the market as more traders opt to sell, anticipating a decline in prices. In summary, the Tweezer Tops pattern is a valuable tool for traders, providing early warning signs of a potential change from a bullish to a bearish market. By identifying this pattern, traders can make informed decisions, such as taking profits on long positions or preparing to enter short positions in anticipation of the market's next move. Tweezer tops are typically indicative of a potential reversal in the market, especially when they occur after an extended upward trend. These patterns are characterized by two consecutive candlesticks that nearly have the same high points. To understand the concept better, let's walk through some examples without the use of charts, but with vivid descriptions that bring the scenario to life. Imagine looking at a price chart where the market has been climbing steadily, illustrating a strong bullish sentiment. As this ascent continues, a candlestick forms that reaches a new high, demonstrating the ongoing optimism among buyers. However, the next candlestick, almost mirroring the prior one, fails to push beyond this peak and closes around the same level. This forms what looks like the top part of a tweezer in appearance, hence the name Tweezer Tops. At this juncture, the inability of buyers to advance further despite two attempts signals exhaustion among them, hinting that a reversal might be looming. While not every tweezer top will lead to a significant downturn, they act as warning bells for traders to evaluate other market indicators before making further decisions. The surrounding market context plays a crucial role in interpreting tweezer tops. For instance, if tweezer tops form at a major resistance level, the reversal signal they provide is more reliable. On the other hand, if they appear without significant preceding gains or not at a historical resistance point, their predictive value may be less. In different market outcomes, tweezer tops can either mark the start of a downward correction in an otherwise ongoing bullish trend or herald a more significant trend reversal. Complementing this observation with other technical indicators such as volume, moving averages, or momentum oscillators can offer a more robust confirmation and reduce false signals. Through these examples and descriptions, we can appreciate the subtle nuances that make tweezer tops an intriguing pattern for traders. Their presence calls for a keen eye on market context and a readiness to adapt strategies based on evolving market dynamics. Tweezer tops is a bearish reversal pattern that typically occurs at market highs, signaling a potential reversal in trend direction from bullish to bearish. Validating this pattern involves looking at additional indicators and conditions that can either strengthen or weaken its significance. Understanding these factors can enhance the ability to make informed trading decisions. One critical factor to consider is the trading volume. An increase in volume on the days the tweezer tops form can be a strong validation of the bearish reversal, indicating a higher participation level in the selling pressure that forms the pattern. Conversely, low volume may suggest a lack of conviction among traders, thereby weakening the pattern's significance. Nearby support and resistance levels also play a crucial role in confirming tweezer tops. If this pattern forms near a significant resistance level that has previously halted price advances, it's likely to be a more reliable signal. The resistance level acts as a barrier, reinforcing the likelihood of a trend reversal as buying momentum fails to push prices through the resistance. The trend preceding the pattern is another essential consideration. For tweezer tops to be considered a valid reversal pattern, they should emerge following an established bullish trend. The pattern is more significant if it marks the end of a prolonged price increase, as it represents a potential shift in market sentiment from bullish to bearish. Together, these factors, trading volume, nearby support or resistance levels, and the trend preceding the pattern, can provide a more comprehensive view of the market context in which tweezer tops occur. An understanding of how these elements interact is critical for interpreting the pattern correctly and making informed investment decisions based on its implications. The tweezer tops pattern is recognized in the financial markets as a bearish reversal indicator, usually appearing at the peak of an upward trend. It comprises two consecutive candlesticks with almost the same high points, indicating a potential shift from a buyer's to a seller's market. When assessing the historical accuracy of tweezer tops in forecasting market direction changes, it is important to note that, like all technical analysis tools, it does not guarantee 100% accuracy. Its reliability often hinges on market conditions and the specific context in which it appears. There have been numerous instances where the tweezer tops pattern accurately signaled an upcoming downturn, especially in highly liquid markets where price actions are more reflective of underlying market sentiments. However, relying solely on this pattern without considering other market factors and indicators could lead to misleading conclusions. The limitations of the tweezer tops pattern are primarily due to its dependency on subsequent market confirmation. The pattern itself suggests a potential reversal, but without confirmation through additional bearish price action or corroborating signals from other analytical tools, its predictive power remains uncertain. Therefore, it is crucial to use the tweezer tops pattern in conjunction with other analytical tools and indicators. Volume analysis, moving averages, and momentum oscillators can provide additional insights, affording a more comprehensive market analysis. Support and resistance levels, along with market news and events, should also be considered to gain a better understanding of potential market movements. By employing a multifaceted approach to market analysis, investors can enhance their decision-making process and increase the likelihood of successful investment outcomes. To combine tweezer tops, a bearish reversal pattern observed at market highs, with other technical analysis tools such as the Relative Strength Index, RSI, the Moving Average Convergence Divergence, MACD, or Fibonacci retracements, one can enhance the predictive accuracy and make more informed trading decisions. Here's how these integrations might work in practice. Firstly, when a tweezer tops pattern appears, it may indicate a potential reversal from an uptrend to a downtrend. However, confirmation through additional technical analysis tools is advisable. 1. Integrating with RSI. The Relative Strength Index measures the speed and change of price movements on a scale of 0 to 100. Values above 70 suggest an overbought condition, and values below 30 suggest an oversold condition. If the tweezer tops pattern forms while the RSI is above 70, this could be a strong indication that the market is overbought and a reversal is possible. Thus, traders might consider this a signal to sell. 2. Combining with MACD. The moving average convergence divergence is a trend following momentum indicator that shows the relationship between two moving averages of a security's price. A bearish signal occurs when the MACD falls below its signal line. If this occurs concurrently with the appearance of a Tweezer Tops pattern, it provides additional confirmation of a potential reversal, reinforcing the decision to sell. 3. Using Fibonacci retracements. Fibonacci retracements are tools used to identify potential levels of support and resistance by drawing lines at key Fibonacci ratios. If a Tweezer Tops pattern forms near a key Fibonacci retracement level acting as resistance, it might indicate that the price will reverse lower, thus providing another layer of confirmation for a sell decision. For example, imagine the stock of a company, Zeiss, has been in a steady uptrend for the past few months. As the price nears a previous resistance level, a Tweezer Tops pattern appears, suggesting a possible bearish reversal. If, at the same time, the RSI for XYZ is above 70, indicating overbought conditions, and the MACD line has crossed below the signal line, these concurrent indicators can provide a strong bearish signal. The integration of these indicators can enhance trading decision making by offering a more robust analysis than relying on the Tweezer Tops pattern alone. Utilizing these analytical tools in conjunction can greatly assist traders in making more informed decisions by providing multiple data points and confirmations, reducing the likelihood of false signals and enhancing the probability of successful trades. When traders encounter Tweezer Tops, a bearish reversal pattern that typically appears at market highs, there are common errors and misconceptions that can hinder their trading decisions. One prevalent mistake is the misinterpretation of the pattern due to ignoring the context in which it forms. For instance, without taking into account the preceding price action and market conditions, traders may incorrectly assume a reversal is imminent, even when other indicators suggest continued bullish momentum. Another frequent error involves over-relying on this single pattern without confirmation from additional technical indicators or volume analysis. This can lead to premature or misguided trades based on an incomplete analysis of the market situation. To improve pattern recognition and analytical skills and avoid these mistakes, traders should enhance their understanding of market context. This means closely examining not only the price action leading up to the Tweezer Tops, but also the broader market environment, including trends in related assets or sectors. Furthermore, traders should seek confirmation from other technical tools and indicators before acting on a Tweezer Tops pattern. This might include looking for a subsequent decline in trading volume as confirmation of diminishing buying pressure or using moving averages, relative strength index, RSI, or other momentum indicators to corroborate the bearish reversal signal. Lastly, practicing patience and discipline is key. Traders should wait for clear confirmation and avoid making hasty decisions based solely on the appearance of potential reversal patterns. By combining a thorough analysis of market context, seeking confirmation from multiple sources, and maintaining discipline in trading decisions, traders can enhance their ability to identify and act on legitimate Tweezer Tops patterns effectively. Tweezer Tops are considered a bearish reversal pattern that typically occurs at the peak of a market trend. This pattern is characterized by two or more consecutive candlesticks that have roughly the same high point, indicating a strong level of resistance. Understanding how to effectively employ tweezer tops in trading involves setting precise entry and exit points to capitalize on potential market reversals. To use tweezer tops for trading decisions, a trader might consider entering a short position once the pattern is confirmed. Confirmation usually occurs when the candlestick following the tweezer top closes below the body of the preceding candlesticks. This suggests that sellers are gaining control and the price may continue to fall. Setting an entry point slightly below this confirmation candle helps in filtering out false signals. Exit points, on the other hand, require careful consideration of support levels and risk management principles. Traders often set a stop loss just above the high point of the tweezer tops to limit potential losses should the market trend not reverse as anticipated. Profit targets might be placed near key support levels that the price could fall to if the bearish reversal materializes. There have been notable instances where traders successfully utilized tweezer tops in their strategies. For example, consider a trader who observed a tweezer top formation on the chart of a widely traded stock at a historical resistance level. By waiting for additional confirmation and entering a short position as the next candlestick closed below the tweezer tops, the trader could have capitalized on the subsequent sharp decline in the stock's price. This scenario underscores the importance of patience, confirmation, and adherence to risk management principles when trading based on tweezer tops. In essence, tweezer tops can serve as a valuable tool in a trader's arsenal, especially when combined with other technical analysis techniques and sound trade management practices. The key to success lies in the ability to accurately identify the pattern, set strategic entry and exit points, and apply strict risk management to navigate the uncertainties of the market. Tweezer tops are identified by their two-candlestick pattern at the peak of an uptrend, suggesting a bearish reversal. This pattern is recognized when two consecutive candlesticks have almost identical high points, indicating strong resistance. Beyond the basic tweezer tops, there are several variations and similar patterns, each with their own unique trading implications. One variation is the tweezer bottoms, which is essentially the inverse of tweezer tops. This pattern occurs at the bottom of a downtrend and signals a bullish reversal. It is identified by two consecutive candlesticks with nearly identical low points, showing strong support. Another closely related pattern is the double top or double bottom. A double top has two peak points and indicates a potential reversal from an upward trend to a downward trend. Conversely, a double bottom has two low points and suggests a reversal from a downward trend to an upward trend. These patterns are similar to tweezers in their predictive nature, but differ in that they are spread over a longer time frame, and the peaks or troughs do not need to be at exactly the same level, only close. The three black crows pattern is another bearish reversal pattern similar to the tweezer tops, but it consists of three consecutive long-bodied red candlesticks that open within the previous candle's body and close lower than the previous candle. This indicates a strong move towards lower prices and differs from tweezer tops by the number of candles and the progression of closing prices. When it comes to interpretation, recognizing these patterns on charts can be highly useful for traders. For instance, seeing a tweezer top formation at the end of an uptrend may prompt a trader to sell their position, anticipating a reversal and a drop in prices. Conversely, spotting a tweezer bottom might signal a good buying opportunity, anticipating an upcoming bullish market. Interpreting these chart patterns requires attention to detail and an understanding of market contexts. While they can provide powerful signals, it's also crucial to integrate other technical analysis tools and confirmations to improve accuracy and decision-making in trading strategies.